Let's understand that why banks are insisting on financial statements, that is the income statement and balance sheet, for taking up loan proposals. Please remember that banks are basically the agents of public. It's public money that is getting channelized through banking channel to the business entities. So when banks divert the public money to the business entities, they have to ensure that this money will come back with return. So how they would ensure? Through various study of entities, business entities, various analysis, and in that one of the very critical or fundamental analysis is financial statement analysis. So banks will insist on presenting this income statement and balance sheet, that is financial statements, for let's say the past 3 years, so that they'll be able to understand the financial position, the operational efficiency, the profit earning capacity of the business. So what are the items that can be understood by the bank by looking at the income statement? By looking at the income statement, the bank can understand how or what is the business they are doing, that is what is their sales, okay, how much is domestic, I mean how much sales are happening within the country and how much is happening to other countries, that is exports, okay. And by looking at the income statement, they'll be able to measure what is the trend, whether the sales is going up or is it coming down, okay. And by looking at this income statement, they'll be able to understand whether they are selling the manufactured goods or whether they are selling the traded goods, okay. So all this can be understood by looking at income statement just by looking at the sales. So the major benefit which the banker will get by looking at income statement is understanding the trend. This is more important. I mean the trend should be on growth path, okay. If it is on the growth path, then banker is going to get benefited by partnering with that particular customer. But if the trend is actually in decline mode, then the bank should act cautious. They have to take a call that whether they should entertain that particular customer or not, okay. So that information can be understood by the banker by looking at income statement. Then the banker will have an idea about the expenses of the particular business entity. So what are the expenses they have? Because the expenses can be broadly the raw material consumed, okay. Then it can be labor, this can be power and fuel, and this can be other manufacturing expenses, then selling general admin expenses, what are the interest costs they have, okay. So all these items are very important, so the banker can understand how much they spend, because when a banker look at raw material consumed, they'll be able to understand what percentage of raw material consumed with respect to production or with respect to sales, and this will give an idea that whether they are spending too much on raw material so that the margin comes thin, or what is the exact proportion, okay. And they'll be able to understand that whether the raw material cost is fluctuating, okay, because by looking at the proportion of each and every year, if the proportion is going up and down, then it's a fluctuating market, then the banker have to be cautious here, because when you lend to a customer who is in a fluctuating market, then it is possible that that company can make loss unexpectedly, and they can also make big profits unexpectedly. The trend cannot be fixed, so that aspect can be taken care or can be understood by looking at the income statement. Similarly, by looking at the labor, power and other manufacturing expenses, we can understand what is the trend that is happening, how labor cost is going up year after year. Then power, because when we talk about power, we should know like what arrangements they have for power, like do they have their own setup or is it purely on the basis of electricity board which the government supplies, or do they have any private arrangement, or do they have anything like windmills, do they have something like solar? So all this can be understood by going through this, right? So that information is also possible. Then we can look into the other manufacturing expenses, then selling general admin expenses, what is the proportion? I mean, whether this is a greater amount when compared with other amounts in the total income and expense statement. Then by looking at interest, we get to know, the bankers will get to know, like who are the other bankers, then whether they are paying heavy interest. I mean, if they are paying heavy interest, it means this company is highly indebted. It means they carry a lot of what is known as financial risk. Okay, because interest got to be serviced whether you make profit or not. So these can be understood by looking at the expenses. So by looking at the income statement, you get to know what are the income, what are the expenses. So mainly you get to know what is the profit of the business, because profit is the exact measurement of efficiency. So if this business is making profit, then they're doing good, and that you get to know only by looking at the income statement. There is no point in simply making the sales, okay, without making profits. So that's about income statement. Then we go to balance sheet. When we go to balance sheet, there are two items. I mean, there are two sides which we talk about. One is liabilities and the other one is assets, right? So what do we understand from liabilities and assets? See, liabilities basically represents the money that is coming from two group of investors, or I would say stakeholders. Two group of stakeholders. I mean, the one is owners and two is outsiders. So we get to understand that who have contributed how much. This is very important because the owner's money is actually a permanent, okay, it is a permanent money, and you don't have pressure to repay that in a short term, okay, whereas outsiders will get classified into short term and long term. So if a business has too much of short term funds, what is the problem? It will create stress in the business because you have to work and work and work to pay these guys. But if it has long term, it's fine. But when there is a long term fund, when there is too much of long term fund, then that business should have created long term assets, because when the long term funds demands repayment, there should be long term assets that are available that should be capable of generating money to pay these guys. Okay, so in liabilities, what we try to understand is who are the stakeholders who have given money to this organization, how much had come from owners. Okay, that is, we are basically interested in looking at the percentage, and how much have come from the outsiders, again the percentage. But that again we classify that into short term and long term. If you have too much of short term, it is going to create a lot of stress, and if you have good amount of long term, it is good, it is going to support what is known as liquidity in the business. But at the same time, there should be corresponding assets that should be created, so that when these guys ask for repayment, okay, when these guys ask for repayment, your business should have resources to support the repayment. So coming back to assets, the business should create assets, and assets can be divided into two types. One is current assets and the other one is non-current assets. Okay, so what is current assets? Current assets are those assets which can be converted back into cash within a period of 1 year. I mean, we can convert that back into cash within a period of 1 year. And the examples for current assets can be like inventory, okay, it can be debtors or receivables, it can be short term deposits, it can be advance to suppliers, okay, or it can be any other items, any other current assets that can be converted into cash within a period of 1 year. So that's about current asset. Then non-current asset can be divided into fixed assets and other non-current assets. So I hope you know what is fixed assets. Fixed assets are those assets which were created with an intention to use. The intention is there to use the asset, okay? And again, the intention is to use the asset for a long term and mainly to contribute to the income generating activity. It means you have no intention to sell the asset. That's more important. You don't have any intention to sell the assets. Fixed assets are those assets which are acquired for usage in the business for long term with no immediate intention to sell. And we can also classify the fixed assets into two types. Okay, classification is possible, that is, we can classify that into tangible and intangible. So by classifying the fixed assets into two types, like tangible and intangible, we get to know like what are the assets actually we have which we can touch and feel, that are tangible, and what we cannot touch and feel, that are intangible, something like patent or brand. Let me change it. Yeah, it's brand or say goodwill. Okay, so these are all the intangible items which we continue to own, but we can't touch and feel them or see them, right? So that's about fixed asset. Then the companies, the business entities will also create various non-current assets. It can be long-term advances. Okay, it can be investments in say subsidiaries or joint ventures or associates, or it can be a long-term deposits with various statutory authorities. So please understand, by looking at the balance sheet, we get these many information, right? We get these many information. By looking at liabilities, we get to know who are the owners, how much they have contributed, so how much had come from outsiders. So you get to understand whether the business is dependent on owners or outsiders. The business which is dependent on owners is called as a strong or a healthy business, okay? Whereas the business which is always dependent on outsiders, okay, it's going to be called as a weaker. Okay, it's not that healthy, it's weaker because it is dependent on outsiders. If any of the outsiders is going to pluck the support, then that business would suffer. Okay, you also get to understand what are the assets that have been created, how much will come back to business as cash within 1 year, and how much is the long term assets, because long term assets are the strength, because that is only going to ensure cash flows, that is only going to create cash flows for the business. Okay, because when we say that we have fixed assets, the fixed assets can be in various forms. Okay, it can be in various forms, this can be land and building. Okay, this can be plant, this can be machinery, it can be vehicles, it can be furniture and fixture. Okay, it can be of any type. So these are all the assets which are actually going to create value for the business. They are going to create money for the business. Okay, so this is a strength, so that we get to understand. So if I try to give a shape for all this, let me try to give a complete shape. So it would look like this. That is, number one, you will be able to understand what's happening on the performance side, from where you are getting your sales. Okay, what is the trend? You'll be able to understand what are the expenses, whether you are making profit or suffering loss. Then by looking at the balance sheet, we'll understand like from where money had come in, or to whom and all we have an obligation, and what are the resources that are available. So this will give you a complete picture. This will give you a complete picture of the business, okay, through two statements. That's why banks are very particular about analyzing the financial statements before taking a call on the loan.
Thanks for watching this video, and I hope you like this lecture. If you wish to learn more on the areas related to this topic, check our comprehensive course. I have shared the details and link in the description below. Click sign up and enroll. I'll see you inside the course.